For the moment, we have to worry about the way the Fed statements and the balance sheet in particular will impact emerging markets, especially India. Mark Matthew of Julius Baer and Company joins us now. Good morning, Mark. Thank you very much indeed for stepping into our studio today. Rather than the rate hike or the lack of it, I want to start with this balance sheet contraction program, which the Fed has clearly indicated stops by September. In fact, they will start tapering that program from May itself. Does that mean a very big boost to liquidity? Will that be extremely positive for risk assets?
Hard to say, because I think what is compensating the reduction in the Fed's balance sheet is the expansion in commercial banks' balance sheets. And the commercial banks' balance sheets are about 7 times the size of the Federal Reserve's. So if they're lending more, and they were last year because interest rates were rising and their margins were getting wider, that should offset the decrease in liquidity from the Fed's balance sheet shrinkage. So,
no, Mark.
I think it's more of a psychological thing.
No, my question was the other way around. The Fed is saying that they will stop that contraction. So that should boost liquidity, isn't it, from September onward?
Right.
So to add to the commercial bank money multiplier and their liquidity, you now have this extra positive that the Fed will not contract.
Yes, that's right. I think, well, maybe the banks will lend a little less because their net interest margins will be lower in such a low interest rate environment. But my feeling is more of a psychological thing, because last year the impression was that this was a hawkish Fed, really for the first time since, trying to remember the name of the gentleman before Alan Greenspan, name escapes me now, but I mean back in the 80s. And Volcker, you're right. So Paul Volcker. So we had Alan Greenspan was an ultra dove, and then Ben Bernanke and Janet Yellen. We thought, wow, we finally got a hawk again, and clearly not the case. And so, yeah, the liquidity tap is on, and that's beneficial to risk assets.
Oh, yes. So we know very well about this liquidity tap. The FIIs have pumped in almost $4 billion in the month of March in India alone, Mark. In fact, the rupee has gone from the worst to the best performing currency in less than 5 weeks. What's the sense you're getting about India itself? Do you think more money could come through?
Yeah, I think so. I think actually the story is becoming a better one in India. The inflation rate is very benign. I don't see why it should pick up. The banks' non-performing assets seems like we're over the hill with those. And the election looks like it's going to go the way the market wants it to go. And there's a bid for emerging markets, which means that passive flows will be positive, from things like ETFs into India. Let's see, what am I missing? And the earnings, even if the earnings growth that analysts forecast this year is too high, which I think it is, even if you shave some off, the fact is that earnings growth will still be quite robust this year. So put it all together, it's not as bad of a story as it was, say, 3 or 4 months ago.
Okay. Well, all that is good. Definitely inflation headed lower. We should probably have a rate cut from the Reserve Bank in April. We are most likely to have a stable government come end of May, when the results will be known. All that is fine. But consumption is not picking up, Mark. We're getting dismal numbers from the auto guys. They are cutting production. We now understand that air travel in India has also fallen off a cliff. It's at a 5-year low. Are these worries at all, or for the moment liquidity is the only god?
That's a great question. I too don't like the macroeconomic data that's coming in from India. It's certainly the missing link. But markets are funny things, and they tend to price in, the future well before it arrives. So I suspect what the market's pricing in now is what's going to happen 6 months from now. And I think it's basically telling us things will probably be better 6 months from now, which kind of makes sense to me. I don't see why they should be worse. Ultimately what moves share prices is their cash flow, and the cash flow, I think, will be an improved number over last year.
Okay, but since there is this concern that, you know, the elections will be held in the absence of an economic upturn, just to quote CLSA's words verbatim, do you get a sense that for now India will be the best performing market, but post-elections there could be a little bit of a change in the way India performs vis-a-vis other emerging markets?
Well, it depends on the other side of the coin. It depends what's going on in the other markets. My sense is that China's really on a tear because, as you know, it's a command economy, and then they, you know, what they did last year is they put their foot down on the brake, and then the growth slowed down much faster than we anticipated. And this year they put the growth on the accelerator, and they're probably going to overdo it. And already we're seeing numbers coming in from China that are much better than people thought they would be. So between China and India, my sense is China will do better, but the major distinction between the two is that India is a structural story and China's more of a cyclical story. And just so I can qualify what I mean by that, they both have approximately the same population now, 1.4 billion people. By the end of the century, India will be 1.7 and China will be 1. So that's the big difference that I think makes India long-term more appealing. But short-term, China will do better.
Oh, not if you're traveling in Mumbai. The prospect of 1.7 billion is not very inviting. But Mark, if you're buying, what are you buying in India?
Well, I haven't changed the view, really. I think that good quality private banks are the way to go because they're play basically on just what I described before, which is the economy continuing to grow a lot, and good quality private banks is my first choice.
Good quality private banks. But just a word on the currency. We've seen a bit of strengthening, as Sonia was pointing out. You think it strengthens more? Any direction or level?
Yeah, I do. Not just India, but the entire emerging asset class is the only place in the world where you get a higher yield than the US dollar. 5 years ago, the most popular currency in Asia was the Australian dollar because you had a higher yield than US. But now Australian, Singapore, all of these currencies, they're way below the US. So the only place where you get paid to own a currency is in the emerging markets, including India. So I suspect that the currency will be fine.
Okay, thank you very much.
All right, Mark, we'll leave it at that. Thank you so much for joining us and giving us your views. So that's the word coming in. Indian market is growing, and irrespective of the slowdown in macroeconomic data, money continues to pour in. Well, we'll take a quick break on that note. On the other side of the break, our list of top 10 stocks is lined up. Do stay tuned in.